For a long time, the idea of merging Tesla and SpaceX was the kind of thing people only floated as a joke. This week, it stopped sounding like one. And a single, very technical step Elon Musk took during the week is the reason why. We've also got two back-to-back records on the Cybercab line, Europe's regulators turning up the heat on full self-driving, a fresh argument over whether Tesla is even an AI stock at all, and a data-heavy week ahead that gives the new Fed chair's hawkish turn its first real test. This is the Tesla Brief, the week ahead, Sunday, June 21st. Welcome to the show. Tesla finished Friday at $400.49, up 0.3% on the week, while the Nasdaq rose 2.7 and the S&P 500 1.4. A strong week for the market that Tesla mostly sat out. The reasons it lagged are most of this week's story, so let's start there. The whole week ran in the shadow of SpaceX's stock market debut, which had closed the week before. And by Friday, one idea had hardened into the main lens investors are now using on Tesla. It's this: that Tesla has become the smaller, slower growing of Elon Musk's two big companies. SpaceX's market value now sits above Tesla's, and the analysts taking their first crack at covering SpaceX have rated it above Tesla too. That comparison did something the discussion hadn't really done before. It took the idea of a SpaceX-Tesla merger seriously. The firm Wedbush put actual odds on a merger happening. An interview with SpaceX's president earlier this month pointedly declined to rule it out. And a weekend piece in Fortune argued the odds climb a little higher every time SpaceX's stock moves up. Here's the piece of context the merger chatter keeps skipping though, because it's the part that actually matters for you as a Tesla shareholder. During the week, Musk crossed 20% of Tesla's voting power. That sounds like a footnote. It isn't. A merger of two companies controlled by the same person needs that person to hold enough votes to push the deal through on terms they set. 20% voting power is the mechanical step that makes that possible. So Musk reaching it isn't a separate story from the merger talk. It's the precondition the merger talk depends on, which reframes the real question. For a Tesla shareholder, the question isn't whether a merger happens. It's what each Tesla share would actually be worth inside a combined company if it did. When you fold a smaller, slower-growing company into a larger, faster-growing one, the terms of that swap decide everything. Get a fair share, and it's fine. Get the short end, and Tesla holders end up owning a smaller slice of the new whole than they'd like. That's the thing worth watching. Not the headline odds, but the terms. And the louder this gets, the more the conversation drifts to the personality side. The All In podcast spent a long weekend block on the IPO and on Musk becoming, on paper, the first trillionaire. That keeps the comparison alive. But the trillionaire framing is really more about him than about Tesla's business. On the product side, the clearest good news of the week was something you could literally see from the air. Drone footage over Giga Texas counted 102 Cybercabs parked in the outbound lot midweek. A record at the time. And by the end of the week, that count had climbed to 120. 2 records in a single week. Alongside that, the Cybercab's EPA certificate surfaced, confirming its battery size, its weight, and a record efficiency rating. And over the weekend, a Cybercab was spotted in New Zealand, so the validation program has gone international. There was a second autonomy sighting over the weekend too. Drone and spotter accounts posted images of a Tesla Semi fitted with what looks like ground truthing equipment, the sensor rig Tesla uses to collect validation data for self-driving. Cern Basher, the Tesla analyst on the Brighter with Herbert channel, confirmed the interpretation, posting, "Tesla autonomous Semi coming to a road near you. FSD for Semi may take some time, but they are working on it." The takeaway is that Tesla's self-driving stack is being pushed across the whole product line at once, not Robotaxi first and Semi years later. And an autonomous Semi has a very different cost story than one with a driver in the cab. Here's how to read the Cybercab pattern note. 102 cars Monday, 120 by Wednesday, validation cars now in New Zealand. That's the kind of evidence that usually turns up 6 weeks before a launch, not 6 months. But set it against the other number. The Tesla Robotaxi fleet actually carrying passengers, unsupervised, is still only around 20 vehicles, and it's been flat at roughly that level for 2 months. So the cars are coming off the line. What hasn't arrived yet is the software and the regulatory clearance to put them on public roads at scale. That gap is exactly what the investor forums were chewing on this weekend. For months, critics pointed to Robotaxi incidents as proof the system wasn't ready. The 4 months of federal safety data since then shows 0 at-fault incidents for the driverless fleet. And as one widely followed poster put it, they literally haven't had one since. So the criticism has flicked. The new complaint isn't that the Robotaxis crash, it's that they aren't carrying enough fares. And the honest read is that both things can be true. 0 at-fault incidents over 4 months is genuinely strong safety data. A fleet stuck at 20 vehicles for 2 months is genuinely not the rollout pace Tesla guided to. The week's bad news came from Europe. Reuters obtained documents showing Tesla used what it carefully called a disputed safety figure when lobbying European regulators to approve full self-driving. The Dutch regulator, which effectively holds the approval keys for the whole EU, pushed back publicly on Tesla's claims. And Sweden went further, formally urging the EU, not just its own regulator, to reject FSD outright over how the system handles speeding. There's a contradiction sitting right in the middle of this, and it's worth seeing clearly. The same week Sweden cited speeding as its reason to reject FSD, Tesla rolled out a streak reward feature that critics argue does the opposite of what regulators want. It rewards drivers for not taking over. So regulators are looking at a system that asks the driver to supervise, and a new feature that rewards the driver for not supervising, and concluding the supervision model isn't intact. That's the real problem underneath the European pushback. It's not a translation issue or a paperwork issue, it's the design itself. And then a fatal crash over the weekend dropped straight into that environment. ABC News and Electrek reported on a crash in Katy, Texas. A driver told investigators his Tesla was on autopilot before it left a residential road at high speed, crashed through the brick wall of a home, and killed a 76-year-old woman inside. Two things to hold steady here. First, this is the driver's account. He told investigators autopilot was on. The police haven't confirmed it, and Tesla's own vehicle logs will be the thing that settles whether autopilot or FSD was actually engaged. Across almost every prior autopilot was on headline, the driver's claim and the log data haven't matched. Second, the timing matters regardless of what the logs show. It lands the same weekend Europe's regulators are already moving, and it hands them a fresh headline to point at. The regulatory split isn't only a European story. In the US, Tesla spent the week emailing its owners in New Jersey, asking them to lobby their state legislators on robotaxi rules. That's the dominant US pattern right now. One state opening up, while another tightens. A patchwork forming state by state. We also learned that Tesla labeled its robotaxi as Level 4 in its regulator submissions. A formal self-driving classification that goes meaningfully beyond the careful language Tesla usually uses in public, and one that carries real legal and insurance weight. Put the US and Europe together, and it's the same underlying question in two different systems. Regulators want a clear answer on what supervision actually means before they'll wave the cars through. The last thread running through the week was a quieter one, a real argument over what kind of stock Tesla even is right now. On one side, a previously bullish analyst turned cautious during the week, pointing to softening near-term demand. Bank of America's Savita Subramanian warned that the AI tailwind is now largely priced into expensive stocks. And in a weekend Wall Street Journal column, James McIntosh argued that the money flooding into AI is itself a warning sign. When, in his words, companies as a group turn into sellers, it's a reasonable sign that stocks are very overpriced. Ed Yardeni at Yardeni Research put numbers on the same worry over the weekend. He flagged that long-term earnings growth expectations for the big tech companies have reached 38%, higher than the 28.7% peak at the height of the 2000 bubble. And he pointed out that a lot of those profits aren't operating earnings at all. By his count, paper gains on AI investments made up 58% of Alphabet's first quarter net profit. That's the quality footnote. A chunk of what looks like AI earnings is the value of stakes going up, not cash coming in the door. On the other side of that argument is Dan Niles, who has flagged Tesla's $26 billion in AI-related revenue as the thing that sets it apart in this rotation. And that's the crux. If Tesla is an AI stock, then the journal's warning and Subramanian's priced-in point apply to it directly. If it's a car stock, the conversation should really be about delivery numbers, not about how much everyone is spending on AI. The week's flat price action suggests the market itself hasn't decided which one it's looking at. One footnote ties those threads together. Cern Basher also pointed out that SpaceX's IPO paperwork names Macrohard, the software venture in Musk's orbit, and counts the chips being assembled there. The signal he's reading is about where AI computing power is being concentrated inside the Musk universe. If a lot of it is sitting outside Tesla, then Tesla's claim on the AI story depends on either paying to use that capacity or building its own. That's a question for another quarter. Now to the week ahead, and it's a data week more than a Tesla news week. The headline event is Thursday. At 8:30 in the morning, Eastern, the US releases the PCE inflation reading, the inflation gauge the Fed watches most closely, alongside GDP and the weekly jobless claims, all at once. This is the first real data test of the hawkish turn the new Fed chair signaled last Wednesday. If inflation comes in soft, it makes that hawkish tone look premature, and that's a relief for growth stocks. Tesla among the ones that tend to feel it most. If it comes in hot, it backs the Fed up, and the pressure that weighed on Tesla late this week likely continues. Before that, on Monday, we get the weekly China car registration data for the prior week, the first read on Chinese demand since the Fed meeting. The question there is simple. Did the gap between BYD and Tesla in China widen again, or did Tesla claw some of it back? It's 1 week of data, so don't overread a single print, but it's the freshest signal we have on Tesla's single most competitive market. On the robotaxi side, the thing to actually watch isn't another Cybercab count. It's whether a single new vehicle joins the active passenger-carrying fleet. That fleet has sat at around 20 cars for 2 months now. Given how many Cybercabs are visibly stacking up in Texas, the moment that fleet number starts climbing is the moment the build versus deploy gap we talked about earlier starts to close. Until then, the production records are promising, but they're potential, not revenue. And the biggest thing on the near horizon isn't this week at all. It's the 1st or 2nd of July, when Tesla reports its second quarter delivery and production numbers. That's the report that settles a lot of this week's arguments. It's the first hard test of whether the smaller, slower-growing Musk company frame is actually right. And the first real check on the analyst who turned cautious on demand. If deliveries come in strong, the merger framing and the cautious bull read both look early. If they come in soft, both look prescient. Everything between now and then, the inflation data, the China numbers, the merger odds, is really the market guessing at what that one number will say. That's the Tesla brief for today. If it's been useful, please subscribe.